Hello, this is Mark Starosciak with Infinium Investment Advisors. You tuned in to our market update video for February 2013. As a reminder, anything we talk about here today is purely for informational purposes. It is not intended to be a recommendation to buy or sell securities. We do not offer tax and legal advice, and please always consult your own financial advisor before making any investment decisions. All right. So, wanted to do a few things here today. One was just a review from our last market update video in November, where we stood on that and some of the predictions we made. And it was frankly a mixed bag. Got some things right and other things not. A chart to send the bears in hibernation, I think you'll find quite interesting. And then what are our considerations at this stage in the world of investing? So let's just revisit, where did we get it right? And one of the things we talked about was a low growth environment, and certainly we've seen that. And I think you just chalk this up to the uncertainty that many consumers and businesses feel. We just don't know what is around the corner. So many people are just pulling back, and that's sort of creating a damper on growth. Now, we're starting to see some signs that that growth could accelerate, but nonetheless, it appears as though it's going to be choppy going forward. So still potentially a low growth market, certainly not what you would see in terms of a normal recovery. And then bonds have been okay so far. So there's been all this chatter about how bonds are going to get destroyed and interest rates are going to spike way up. Now that certainly hasn't happened yet. Doesn't mean that it won't, but we just haven't seen that yet. And once we do, that will be reflected in bond prices. They will go down. But to this point, bonds have remained somewhat stable, although rates have started to trend up. It's been nothing extraordinary at this point to really cause a lot of damage. And we also talked about gold and U.S. dollar being in a tug of war, and that certainly seems to be the case. Now the dollar has strengthened recently. Gold has really continued to struggle. So those, all the ads again that you saw on TV and those promoting gold as a way to protect yourself have been dead wrong. So again, when you see a lot of hype and a lot of interest in a particular area, that can go on for some time, but eventually it becomes dead wrong. And we would squarely put gold into that category. So where didn't we get it right? Where did we get it wrong? The political certainty that we've seen has created some risk-taking. And this gets back to an old theme that we've talked about, which is the markets can handle bad news. It's just uncertainty that they have a very difficult time dealing with. So we've seen that with the fiscal cliff getting solved. Not a great solution, no matter what side of the fence you're on, but nonetheless a solution. No one's ever going to be 100% happy with it, but that has seemed to allow investors some room to take some risk, and that has really been, it has a lot to do with why the markets have gone up. And again, we've seen some level of compromise. A lot of tough talk in Washington, still a lot of tough talk, but at the end of the day, they reached an agreement. That will probably happen here with the sequester that is at the fore of people's minds. And then, there have been better earnings, and we point this to really pent-up demand. So you had all this uncertainty coming out of the summer last year with Europe, plus the whole political presidential election. And once you got that out of the way, the markets, seem to have opened up a bit. So the last earnings that in the fourth quarter for 2012, those last earnings that we saw were actually pretty decent. Now, again, you had analysts ratcheting down their earnings expectations going into that. So that's always or potentially a good sign. They were a little too pessimistic in reversing course and saying, hey, earnings aren't going to be quite as good. So that sort of set us up for those beats that we saw. And I believe something like 70% of S&P companies that reported, have beat their earnings estimates. So when you start to see that or continue to see that happen, that is a good precursor for higher stock prices. So here's another chart. This we call the bear crusher. And it simply shows you the flows into ETFs and mutual funds where investors have been putting their money since the low in March of 2009. So this chart is courtesy of our good friends at Fidelity. And what it shows you is a huge disparity. This top line is the money flowing into bonds. Bottom line is money flowing into stocks. Now that's recently reversed here into January. And that alone, if this dynamic continues, where we see a reversal of what's happened the last 4 or 5 years, that in and of itself probably creates some type of floor for stock prices. But as we know, individual investors are very fickle, and so oftentimes at the first sign of trouble, they tend to get flustered and pull money out. So they can be very not necessarily a predictor, but very coincidental in terms of what they're doing and what's happening in the markets. But nonetheless, this warrants paying attention to, because you would think over time that these have to have some type of mean reversion, and potentially people are going to start getting more comfortable with stocks again. All right, so where are we now? And so we'd say, this is an S&P chart for the last year. Even sprinters need a break too. So it's been a pretty large sprint up here. We had some disruption at the end of the year because of the fiscal cliff. But by and large, when you see this straight of a line at this trajectory with very little volatility, at the very least, you need a pause. Now, this week, we did see quite a turnaround again yesterday, followed by a nice rebound today. But nonetheless, if nothing else, you might see the volatility increase. And at best case, we'd like to see this move sideways. And we'll talk about that in a minute. But this cannot go untested, so to speak. So our view is that now is probably a pretty good time for the market to make somewhat of a shift out of this low volatility and straight up type trajectory. So our considerations, markets will go to extremes. And so our view is that low, all-out low in terms of sentiment, how people feel, and their asset allocation, the amount in stocks, from that low in March of 2009, it's got to meet a high probably sometime in the next several years. Could be this year, it might be 1 or 2 years down the road. We just don't know. But there is probably going to be a yin and yang here between this all-out low we haven't really ever seen and some type of euphoric high. That is probably the biggest danger, the biggest risk here, is that we get to that euphoric high, and if investors are still too light in terms of their allocation to stocks, they're going to miss it. So really, that could be the biggest risk looming out there, not necessarily another big drop. So where are we now? As we mentioned, greed is starting to overtake fear. So fear of losing money versus greed and, boy, I'm missing out and I better get in. I want to earn some money, want to take advantage of these higher stock prices and a better economy. It's interesting that we're starting to see that greed overtake fear when the markets have already moved over 100% from the low in March of 2009. So that bears watching. So again, we talked about a pause, the pause that refreshes. Hopefully we're in that stage right now. So the question becomes, what is your strategy? When there's certainty, generally that means lower returns because people are fully invested. They have confidence, right? So when everyone's fully invested, who's that next incremental buyer to come in? There isn't one. So you need fresh capital, but you don't see a big change in asset allocation because, again, investors are fully on board. So as we get more certainty here, we would expect lower rates of return potentially going forward. And to contrast that, in the last several years, again, you had over 100% move from the low in March of 2009 with a ton of uncertainty, and you've seen higher returns. In 4 years, you've made over 100%. Rarely do we ever see those types of returns in such a short amount of time. And it's not because things were all that much better in the last several years. It's that it sold off too much. So those that were able to step in and take advantage of that have made terrific returns. It always comes back to, what does your money need to do for you and when? And of course, we would say that this really centers on your financial plan. So if you have a plan in hand, you know what your money needs to do for you and when, you're much more likely to see success and avoid some of the mistakes that we've seen many investors make in the last several years. With that, I'm Mark Starosciak, and we will see you next time.